Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US Credit and Global Market Engagement at Informa Global Markets. I'm here with my colleague, Bruce Clark, head of Rates
Morning.
Market Coverage. Hey, Bruce.
How are you?
Good. And
Good.
Matthew Barrett, our upcoming star. Matthew.
Thank you very much, Shanks.
Yeah.
What a welcome! What a welcome that is.
So Matthew is our senior credit analyst covering European credit markets. And the reason we have him here today with us is because we are going to talk about a very interesting theme of American companies issuing in European markets. So they have done that a lot this year to achieve funding diversification, or taking, not raising everything in one currency but trying to raise it in different currencies. And they've gone to the European markets, which are really liquid, as not as liquid as the US market, but as equally as liquid as one of the top international bond markets. So these kind of bond issuances are called reverse Yankees. That's what we all call it. And so reverse Yankees is basically a take on the term of Yankee Americans going to different markets. But so far this year, we have seen massive bond offerings to fund AI infrastructure from the likes of Oracle, Amazon, Alphabet. And response to them has been overwhelming, to say the least, right? With most of these deals, setting records for the orders they're receiving. Like I think Oracle's 25 billion 8-part deal had like $130 billion of orders from investors. And so the demand for these types of deals are great in the dollar markets. But then the whole AI funding realm is expected to be a massive, uh, you know, um, fundraising by all these companies into one currency. If they start doing it in one currency, people will start wondering. There would be overcrowding, costs will go up for these fundings. So that is why the prospect of this overcrowding one currency market with more jumbo bond issuance and the risk of increased funding costs is necessitating this, funding diversification into other currencies, sort of spreading the love a little bit, right? And so after Oracle, all the AI funding we are seeing are having multiple currency issuance. And part of it is prompted by this really complicated thing called interest rate differentials, and basis swaps. So, Matt, please tell us what's explain the mystery behind them and let us know, what's been driving all this and what's the status so far.
Yeah, sure. Yeah. Again, thanks for having me on. You guys are doing a fantastic job with this, and it's a pleasure to be
Thank you.
part of it. But yeah, I mean, there's different differentials, as we would say, between Europe and the US. They're definitely playing a part in bringing issuers across the pond to sort of raise that funding that they require. I mean, we've seen the ECB cut rates last year quicker than the Fed, so sort of the underlying benchmark or yield that you're paying is obviously
Right.
a little bit cheaper over this side compared to, say, in the sort of, I say this side, I'm in Europe obviously, compared to the US. And there's a sort of the cross currency basis swap, which is sort of, it's two benchmarks where you're issuing in one currency and then
Right.
you can compare the two and you're swapping them back to the other currency, whichever it may be. So in this case, it would be US issuers issuing in euros, but then being able to swap it back to dollars. And that's sort of stayed in a very tight range of around 0 to 5 basis points, which in turn means sort of low, stable costs for swapping euro funding back into dollars, which is obviously the predominant
Right.
currency which these guys are using for their funding needs, whether it be AI or anything else.
Right.
That sort of lower level has in turn sort of, it's really put the reverse Yankee market has always been a big market. We had a bit of a dip a few years ago when Trump first came into power the first time round,
Right.
where there was a little bit of incentive to keep cash onshore as opposed to issuing foreign debt and bringing it back.
Right.
But since then, we've had a very steady flow, and the last couple of years have been very, very busy.
Right.
Um, but I mean, that differential that still stays low this year has definitely helped issuers become more attracted to the euro market.
Right.
Um, whether it be for those pricing metrics that we see that are quite favorable, or as you said earlier, Shanks, the sort of
Yeah.
diversification reasons.
Right.
Um, but just to sort of just as an example potentially of showing sort of how attractive this euro market can be for
Right.
US issuers, we've seen a few examples this year of as you said, the sort of multi-currency issuance. But just taking one example, we saw IBM in January this year. They priced a is a 3.5 billion four-part deal in
Right.
euros,
Right.
as well as a 3.25 billion five-part in dollars.
Right.
So the longest 12-year euro line of that, priced with an interest rate of 3.85. So basically the yearly coupon, which is what they're going to pay on the debt that they've raised.
Right.
So that 3.85% was a lot lower than the 4% coupon, which was issued on the shortest 3-year dollar bond. So
Wow.
that is just
Right.
is a perfect example there of, the all-in cost at the very least,
Right.
how that the euro market can be a little bit attractive to the US guys.
How is that changing? Because that's the situation with the trajectory of European interest rates has changed fairly dramatically in the since the war began, in Iran, and sort of exacerbated by central bank meetings last week, where the Europeans and the Brits sort of vociferously got behind the idea of hiking rates as a response to oil prices. So how is that obviously changes the outlook on, the situation you just described may no longer exist, right? Because the trajectory is quite notably higher for
Absolutely.
European interest rates than it was a month ago.
Yeah, I mean, going forward, it's going to definitely play a part. I mean, but so far this year, I think so. We've got reverse Yankee supply is running around what are we at? We're about 40 billion. It's in the
Right.
Q1, which is compared to 22 billion in Q1 2025. So I think, yeah, going forward, I mean, that's definitely going to sort of play a little bit of a part. And yeah, the sort of hike bets, if you would like, they are ramping up, and we've seen underlying yields have obviously spiked everywhere, but in Europe, we're definitely seeing that. Um, that may make the sort of marketplace a little bit less attractive for these US guys.
Right.
However, as we've sort of already touched upon a little bit, which I'm sure we'll touch a bit more as we go on, we've
Yeah.
got so much diversification needs. There's a lot of M&A funding to also be done. So
Right.
even though it may be a little bit less attractive, we're still going to have to see issuers want to sort of, as I say, issue in multi-currencies.
So it is
Right.
not just about cost, right? Like it's almost like they don't want to just issue it and say, oh, I saved a few basis points by doing it, because at the end of the day, if you're raising hundreds of billions of dollars, and say even if you paid 5 or 10 basis points in so-called new issue premium, in kind of spreads, that's not a lot, right? Like, because the size that you're able to raise through these markets, I don't think that people are going to worry so much about, they are more worried about how much I can get money out of these markets at a reasonable rate, right? Like if it is 100 basis points, like I have
Of
to pay
course.
a 100, like a 1 percentage point over as a premium, then I think people are like, oh, but then we are talking about markets that are really bad, right? And
Yeah,
so,
absolutely. And also,
yeah,
sorry, just there's
yeah,
also there's obviously these massive companies, the AI giants of this world and stuff like that. They also have a lot of operations in Europe, right? So there's
right,
not necessarily that need to swap
right,
back.
right,
So if you're issuing in euros, then there's obviously that, especially if it's through one of European funding arms, which some issuers do, then you've
right.
still got that money then on the right shores, if you'd like, without having to need that for other purposes.
One more thing though, Matt, like they have issued like in Swiss francs, right? Some of these companies. But that
Yeah, so
market is so small, right? Like I think they did what, 500 million or 300 million? And that was like one of the record bonds, right?
So Amazon is obviously, so we've, as I say, we've seen 40 billion worth of reverse Yankee. So that's US issuers issuing in euros.
Okay,
But yeah, I mean that was given a big boost by Amazon.
right.
who of course they sort of what did they take? It was 14.5 billion out of the
Right.
euro market, and it was
Right.
via an 8-part. That's the first time a corporate of any ilk has done
Right.
an 8-part trade. I know that's quite popular in the US for these big guys, but we'd usually see sort of smaller, maybe 5 or 6-part at a push.
Right.
So that trade actually knocked off AB InBev's 13.25 billion 6-part from way back in 2016
All right.
off top spot in terms of the largest single currency corporate trade ever.
Right.
But yeah, sorry, just going back to what we said there. I mean, we've seen Alphabet also in the market in euros last year. They printed a 6.75 billion 5-part in April, and
Right.
then a 6.25 6-part in November.
Right.
And they were the biggest euro trades of 2025 across all jurisdictions. This year, Alphabet have decided that that's not enough. They're going to diversify further. So
Right.
they did a 5.5 billion sterling trade
Right.
in it was last month now, and that was the largest ever sterling trade from a corporate ever.
Wow.
And not only happy with that,
Right.
on the same day, they took 3 billion out of the Swiss francs market,
Oh, 3 billion.
which
Okay. Sorry.
3
Yeah.
billion, and
Yeah.
that was a 5-part it was.
Right.
And that was another volume record in terms of corporates for that particular currency. So, yeah, I mean, and those deals, the sterling deal was, I think, 28 billion book. So that just underscores the sort of demand there is either
Right.
in that currency or for that
Oh,
sort
so
of AI
there is.
product.
So when you said 28 billion for a 3 billion trade, that means the market has the capacity. See, but of course, the problem we always come across in these markets is that order books could be padded up, right? Because people want allocations, so they're like putting more orders than they need. But um, but 28 billion sounds for the 3 billion trade, which was the biggest. See, the reason I'm trying to talk about this is because I'm thinking, okay, diversification is all great. But when these guys diversify, or they have already diversified, when they do trades like 3 billion, which is small in the American context, because it's like they do 1 billion trades just for nothing, right? And when they do 3 billion and this market has the biggest deal, right? Like, so how much more can they do in markets like these, right? Like, that's the question which comes into my mind is that can they do another 3 billion trade after doing a 3 billion trade today, and then can they do one tomorrow, right? Like in the US market is possible.
Yeah, I think they probably could. Maybe not tomorrow, but if you're getting your sort of fill in that currency, that then you might have a little while to investors, as I say, might have their fill, so their books maybe fill up on that
Right.
particular name at that particular price or whatever it may be. But I mean, for other names, if they wanted to come to the sterling market, there's definitely the investor base there that are
Right.
willing to put their money to work, if you'd like. And in the Swiss francs, it's obviously a lot smaller market. But again, these names are attracting huge attention, and they know that they're going to have to keep doing funding. So I think that it's definitely there if others or themselves want to look at it.
Right. And Bruce, do you think it's all a bit of like going away from the dollar, so people like to, from here they might want to buy some Swiss francs?
Yeah, I mean, you've heard. I think that sort of de-dollarization
Yeah.
trend. I think it's overhyped.
Right.
It started back with the tariff regime almost a year ago, and with the war, it got another kick. But sure, I think there probably is some it makes sense for some of these large corporations to diversify into other currencies, just to as you would diversify a portfolio and just sort of spread your risk around a little bit.
Yeah, just to
Right.
touch on
So,
that, Bruce, you said
yeah.
about it happened in 2025. Sorry, Shane.
Yeah.
Just
No, great.
I mean, we saw, I think the reverse Yankee SPY last year was 99.6 sorry, 92.6 billion. So that was the second highest ever annual funding total for the reverse Yankees, and that was only beaten by it was 99 billion in 2019. So that just showed you that it's a kind of a theme that's been carrying on this year from last year.
Yeah, but Matt, could you also speak about this? Like there was one interesting thing you said earlier about this earlier deals were 5 parts, now there are 8 parts. So
Mm.
is that a sign of a market which is getting broader? Because the US, it's common to have multi-part tranches, but as far as I remember, and correct me if I'm wrong, is that the European markets did not have multiple parts like the US, right? Like they used to have a few parts, but not as crazy as the US. Do you think that's changed nowadays? Like because they need to provide for
Yeah,
these?
yes, definitely. But if they're going for this size, to take say a 2 billion out of one single tenure is going to be a little bit of a stretch at times.
Right.
So I think again, it's kind of feeding into that diversification, whether it be different currencies or whether it be staggering issuance or debt across the tenures of,
Yeah, the
yeah, exactly.
maturity.
So
Yeah.
yeah, I'll find my teeth in a minute, don't worry. But but yeah, no, definitely. But we have seen more, but that's because issues are going for size. But also it's a bit different in Europe in terms of the US guys, that they're basically on the run tenures, aren't you? You have the
Right.
whatever, whereas we have more sort of 5.5 year or 6.5 year. So again, that allows the sort of issuers to be able to sort of spread their debt maturity across
Right.
an even wider range. Again, so you're not piled up at one tenor as opposed to.
And can you tell me about the demand a bit, right? Like for the bonds. So obviously so much reverse Yankees. How has the demand been? Like obviously books are very big, but there a preference for some tenors, or do you see that? Because I think in Europe you guys get the split on how these things are
Yeah, we
bought.
do.
Yeah.
We certainly do. So it's a bit hard to talk about pre-war or pre-Iran
Yeah.
and post because there's a bit of a differential. But where underlying rates were very, very low, then we
Right.
saw a lot of hunt for yield. So if investors were looking at the sort of longer dated bonds, which offer a bit more of a coupon to sort of
Right.
lock in those levels as opposed to the shorter dated stuff. Not to
Right.
say the shorter dated stuff didn't see plenty of demand because it did,
Right.
but we'd always see the sort of skew of the combined order books would be towards the longer end. So
Right.
um, where interest rates are coming up again, well, interest rates potentially coming up again, and the yields are sort of rising again, that we may sort of see that evolve a little bit. But at the
Right.
moment, especially as there's so much volatility, investors may want that sort of shorter tenor insurance, if you'd like, as opposed to buying it at 20 years when
Right.
you could sort
Yeah.
of go for the 5 year option or whatever it might be.
Hey
Also,
Matt,
yeah.
sorry, Shanks. We've sort of had an ongoing debate here since even before the war began. But what was it, Shanks? Was it even the second week of the month? Even though the war had started, there was the second busiest corporate
Oh
issuance
yeah, yeah. February, yeah.
week
I think
week on
January has been the
record.
busiest. February has been the second busiest. I think March
Right. So
is very busy as well. Yeah, correct.
as a macro guy, I look at that two ways. I say, okay, well, if I go back to the COVID era, when rates were very low and it was obvious that supply chains were being impacted, there
Yeah.
was a massive rush of corporate issuance to get ahead of what I presume everybody saw was inflationary pressure. Rates are going to go up. Let's issue now and lock in good funding.
Right.
Okay. Now the other side of that is, um, this record week early in the month, there was also massive demand. I mean, the average book was almost 4 times oversubscribed.
Yeah.
That week it was massive. So at the same time, it appeared corporate treasurers are trying to get ahead of higher rates and lock in good funding, but then the investors were saying, yeah, we're willing to look through this war
Yeah.
and lock in for us, lock in this increase in war premium,
Yeah.
this higher yields. How do you think that's playing out? I mean, is that changing? I mean, are people becoming afraid that inflation is going to run away here, or is this bump up in yields during the war an opportunity to lock in yields that, I mean, for example, the 5 year treasury, or I'm sorry, the 20-year treasury is trading at 5%. That's kind of a big benchmark here. And, I don't know, 3 months ago, guys thought they'd never be able to lock in 5%, but here you are, here we are. So is it an
Yeah.
opportunity or is it something we should be afraid of?
I think it depends which that sort of standpoint you're looking at it, right? Because
Right.
we've had a lot of issuance this year. So I think just the corporates, this is ex-SSA and financial stuff, which is also sort of running at sort of very high total so far this year. But we saw about 120 billion price in Q1. in just the Euro corporate market, which probably is dwarfed by the US guys, but it's still at a record high, and I think it's about 30 billion ahead of where we were at this stage last year. So that just shows you sort of how much issuers, sorry, have raised funding at the start of the year and locked in those lower yields which you had. I mean, it was kind of the market's good, why wait and see? And maybe
Right.
they've sort of been proved right with the escalation we've seen in the Middle East at the start of this month. Um, but I think it depends which way you look at it. If you're an investor, then that extra yield on offer is very nice. However, if you're an issuer and you were looking, say, 2 months ago, and you're probably thinking, why didn't we go then? You know, we've now got
Yeah.
to pay this extra yield or coupon, and also sort of tying in with that on top of that. So the new issue concession, which is what we see, say an issuer has an existing curve where their bonds are trading, and then how much of a premium they're paying on top of that, of where we would see what we call fair value, right?
Right.
So to get investors to play ball in the last couple of weeks, we've seen a big jump in that sort of final new issue concession.
Right.
So last week, for example, there was 11 corporate trades, not huge, they were quite small in size, but we saw the average new issue concession, or NIC as I will call it from now on, so I don't have to keep saying new issue concession and get my tongue tied, was about 14.5 basis points, which is very, very high compared to what we've seen this year,
Wow.
last
That's
year, and even
right.
in the wake of the tariff stuff last year, we didn't get anywhere near as high as that. In fact, this was so across the week, it was a 2.5 year high. So that just shows you how much things have moved. So I think investors, as long as they're being compensated, they're willing to stay on board. And we've seen that for the deals that have gone live in the last couple of weeks, where we've seen sort of an escalation in tensions, bit of a pullback, but still that volatility there. We've seen investors stay on board if that premium's there. If it's not
Right.
there, there's been a bit of resistance, and it's sort of forced issuers to be a little bit more pragmatic. Um, but supply has slowed, so I think the number of issuers that are willing to play ball at the moment is definitely lower. But should we see any obviously sort of meaningful breakthrough in peace talks, which I know have been muted this week,
Right.
then markets are going to react, and I think that could end up sort of bringing us back to those sort of pre-war
Yeah.
levels of issuance and then pricing terms as well.
Absolutely. You guys correct me if I'm wrong. Like, but I'm like thinking aloud here a bit, right? In the sense that if the if there has been so much record issuance in dollars, but the new issue concessions haven't really spiked up to what the levels are in Europe. So, first things, it almost shows the depth of the market, right? Like the investor base in the US is so diverse and so broad that they can still keep buying without, and borrowers can keep issuing into a market without actually paying a huge compensation for it, because there is a big demand for it and a lot of investors are coming in to buy this. And I think on the other end, you see Europe, which is getting this record issuances, but then investors are saying, oh, come on, I need money. If you need the money, you have to pay up. And the borrowers have to cough up. But still, 14 basis points is not that bad, right? In the broader context of things. But
Sorry,
yeah,
just to jump in, it's not bad, but I mean, issuers have been so used to either pricing flat to
right,
or through where they would through their existing curve, right? So if
right,
someone gets used to it and then all of a sudden it's not there, I think there's definitely issuers are going to start looking twice and start thinking about how quickly they want to come in, or whether they want to wait instead and see or hope, whichever way you want
right,
to do
right.
it, that things get better, whether it be in the Middle East, which then have a knock-on effect to sort of global risk markets.
So because like the point I'm seeing here is that so you can have your cake and eat it too in Europe, right? In the sense that where the borrowers are able to issue cheaper than dollars or use the money for whatever they're doing overseas, and the investors are also getting paid a little bit of compensation better than what the Americans are getting paid or the American markets are paying, right? So it is almost like it is it is a great market to be in for both. And the war premium which Bruce was referring to, it seems like the the Europeans are paying that war premium and investors are locking it in. That's I was just thinking that aloud, but I don't know whether that
Yeah, I should say as well. So we've had just a small spattering of deals this week. It's been very, very quiet again.
right.
Um, but it was on what day was it? Wednesday now. So things move so quickly, it's hard to keep up which day we're on, as you guys know very well. But we saw it was Danfoss and Danone, so European names. They issued in euros.
Right.
But when the tone was obviously a lot better on Wednesday,
Right.
with those sort of peace hopes and everything else, and they actually did manage to price with zero new issue concessions. See, I told you I should have stayed with Knicks, um, but they managed to price with zero. So it just shows you that when, even though it was only a sort of fleeting positivity, when the market is strong, as in when I say the market, the broader market tone, stocks, oil came back down, everything like that, then issues maybe have that little bit more flexibility
Right.
and pricing power. But when that volatility hits again, which at the moment we know can be at any point, at any second, you can't
Right.
look at the screen 1 minute, look away, it's completely changed, right?
Right.
But if there is there, then there is still sort of some what we call economic funding in terms of pricing versus their existing curve is there. But then yesterday, the tone again deteriorated, and we saw a couple more issuers come, and then they were actually forced to again pay that sort of 10, 15 basis point nick, which we had been accustomed to last week. So I think it's going to take a very nimble and maybe again pragmatic approach for
Right.
issuers. If there's a window of opportunity that presents itself like it did on Wednesday, issuers are probably going to want to take it. And as
Right.
I think I said earlier, if there's a meaningful sort of 2, 3 days of positivity, stability, then we will see that issuance pick back up again and sort of keep propelling us to sort of record highs throughout the year,
Right.
hopefully.
Right. So even if you pick the window of issuance, given how volatile the news and sentiment is, it is still that you're not sure you're picking the right window, right? Like it's a very interesting
Absolutely.
part of the market now at this point.
Absolutely, and I think that window is more likely to be taken, or potential window, you never know where we're going to end up, as I say, but that potential window is going to be taken up by those that need the funding, as
Right.
opposed to are just sort of monitoring the market. So we've had a lot of issues this week and last week that have had upcoming maturities of euro debt. So one of their X 5 year bonds is say maturing this month or next month, so they've got to repay that. So they're raising funding again, new issue bonds to then
Right.
repay that. And we've had a few M&A examples as well. So there was a Coca-Cola HBC deal yesterday, but they did a
Right.
three-part, and that was to fund the acquisition of one of the other Coca-Cola bottle companies, which the African
Right.
Coca-Cola bottle. So if you need to get the funding done, then you can get it done, and there's still investors are still keen. It's just
Right.
we'll have to maybe pay that extra premium, and others are not too keen at this moment to sort of jump in their
At,
numbers.
at the same time, though, Matthew, like earlier, you said something which was very interesting, which is, why did I not do it 2 months before? Right. That's
Exactly.
so you will
Hindsight is a
have that.
wonderful thing, Shanks, as we know. But yeah,
So actually, Bruce, I wanted to ask you, like, when we are talking about this whole interest rate differential stuff and all, I know you have a very strong opinion about all this rate hike talks, expectations. What do you make of it? Like, do you think the Americans are going to hike more than the Europeans, or who is going to do what, or what are you thinking? What are you looking at?
No, I don't. Just to give some background, before the war began, the U.S. interest rate complex was pricing rate cuts throughout the course of the year. Okay,
Right.
as much as perhaps 2.5 rate cuts, so 60 basis points of cuts, let's say. The war comes along, supply chains get disrupted. Immediately, everybody flashes back to COVID. Okay, what the last time there was a massive global supply chain disruption. Now, COVID was different because the governments at that time were like throwing money at people to compensate them for closing down the economy. Anyway, but inflation brewed and percolated out of that COVID and forced central banks to raise rates rather quickly, as we recall in 2022. So again, memories are short enough that they go, oh my gosh, supply chain disruption, central banks are going to raise rates. The Europeans and the Brits came out last week and said pretty much, yeah, that's what we're looking at, because we fell behind the last time. We're not going to let it happen this time. So as we sit here today, the UK market now has 80 basis points of rate hikes priced over the rest of the year.
Wow.
The European market has 85 basis points. The Japanese have 60. And the Fed, the US here, the Fed last week, to their credit, I think said, yeah, let's just take a wait and see approach. I mean, these energy shocks, they can go various ways. So let's just take a wait and see approach. Nevertheless, the spillover from these other markets has now pushed the futures market to price 15 basis points of rate hikes in the US market over the course of the year. So the war has radically changed the interest rate trajectory of all the major economies.
Right.
Now, you can argue that higher oil prices it's a supply side phenomenon, not a demand side issue, and that raising rates is precisely the wrong thing to do in that, which that's the camp that I'm in. Europe, for example, they rely on imported energy.
Right.
And that's the higher oil prices are acting as a heavy tax already. And now the central banks are going to raise rates on top of that. I mean, I don't think that they're.
So what is the reason
I think they'll
behind it?
regret that. But anyway, that's not today's trade. But what's in front of us is the central banks have adopted an attitude that we're going to tighten rates into this energy shock.
So what is the argument for it, though? Like, why would you want to raise rates in a market like this? Like, what?
Well, I mean, because because higher oil prices, oil's at the top of the supply chain, right? Higher oil prices mean higher oil prices, higher prices for fertilizer, for food, blah, 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 the whole list, right? And so then that inflation becomes, just as they were getting inflation from COVID back under control. Some countries, the inflation was starting to fall below 2%. All of a sudden, you have another potential threat of higher inflation again. So it's forced the central banks to pivot from an easier policy back toward a tighter policy.
Right.
So anyway, what's interesting, what interesting to me, what happened this week is, and Matt talked about, we're sort of coming to feels like we're coming to some kind of inflection point here. Treasury had auctioned off 2, 5, and 7-year notes this week. Very weak auctions.
Right.
A lot of trepidation to buying paper, which you all have seen in the corporate bond market.
Right.
And I think that because what's happening is that it's becoming obvious to the markets that with this Iran conflict, time is the enemy. Okay, if you'll notice, President Trump came out late yesterday and said, that 5-day deadline that we had for not attacking Iran's electrical grid unless they open the Strait of Hormuz, we're going to extend that by another 10 days.
Right.
Okay, now, previously, the markets would be like, yay, and there would be a relief trade, right? Stocks would go up, bonds would go up, everything would go up, right? Didn't happen, right? Because a 10-day reprieve just means 10 more days of higher oil prices and 10 more days of uncertainty, right? So time is an enemy here. It's not, as opposed to during the tariff rollout, he goes, oh, well, let's hold off for 30 days. Time was a friend. Time is now an enemy in this situation. So you have US troops moving into the region. It just feels like there's some geopolitically, financially, it just feels like we're building up to some kind of inflection point where there's going to be clarity one way or another. Right.
So here actually, Bruce, I wanted to ask you, like Trump obviously wanted rates to be cut sooner, right? Right before this started, right? I think that he was asking the Fed to cut rates.
Right.
Now, now people are talking about hiking rates, right? And though the Fed is on hold, so I remember we had a podcast before this where with Megan Robson from BNP, where she said they were in the hold camp from the start, right?
Right.
And now this does it embolden that claim? Now I think instead of hike, which is so unexpected, do you think people will say, okay, I think the best option would be just hold, don't do anything? Is that where it is going to end, you would think?
I think it will. I think the bar, and as Megan said, the bar for hiking rates is very high.
Right.
It's a very high bar for hiking rates. So I think that the Fed would, BNP's assertion for the Fed being on hold was that the economy was going to perform better than expected, and there was
Right.
no need to cut rates. And we've seen that. Just yesterday, the recurring jobless claims.
Right.
There's been a lot of worry about the employment market, and you see all these headlines about layoffs and everything else. Most of the job data is actually pretty good. Yesterday,
Right.
recurring jobless claims fell to like a nearly 2-year low. So these are people that have long-term unemployed,
Right.
that are applying for unemployment benefits. A 2-year low, very good number. So that, I think that was BNP's assertion, was that the economy was healthy enough that it would preclude the Fed from having to cut rates.
Right.
So yeah, I mean, the president, obviously, for all presidents want to lower rates to lower the cost of credit cards and mortgages
Right.
and everything else for electoral reasons. But and even if Kevin Warsh, the incoming Fed chair, were to be confirmed and seated in May, as it stands now, he wouldn't get the votes to cut rates. Even if he wanted to, he wouldn't
Right.
get the votes on the board to cut rates. So look, I think the Fed is the cooler head here, and they've essentially said energy shocks, we should do our best to look through,
Right.
rather than draw these conclusions, as the Europeans and the Brits seem to have done early on.
Right.
And so I think that's why the US is pricing a much tamer reaction, a much tamer increase in rates than Europe and the UK and Japan.
So in that case, Matt, it almost seems like the Americans might be on hold while everyone else is, going up quicker. That differential is going to go the other way, I think. Was
Yeah,
it?
potentially.
Yeah.
Yeah, definitely. I mean, yeah, I think it could definitely sort of make it a little bit less attractive in the euro market. But I
Yeah.
mean, the situation, as we know, is just so fluid at the moment. It could
Right.
take a breakthrough and an easing back in, a big easing back in tensions for those interest rates to sort of the forecast to move. But yeah, I agree with what Bruce's saying there. It's very interesting that the US is
That's the thing,
trading.
Matt. I mean, this is not like COVID, where
No,
we have this global pandemic and we have to wait a year or 2 years to reach some kind of herd immunity for the world. It was fairly predictable, right? The timeline was not predictable, but it was elongated. This thing is like we're going from headline to headline.
those headlines and the sort of moves and the volatility is exactly what issuers do not like. If they
Yeah.
sort of know, if they know it's stable, or they know, even if they know it's going to be a sort of stocks are down 0.5% or whatever it might
Right.
be, and they know it's going to stay that way for the rest of the day, they can sort of process that. They can put that into their pricing strategy and whatever else. It's when stocks open up 1% higher and then by the end of the day they're nearly 2% lower. That's what
Yeah.
they don't like. They don't know where to do, because then if you sort of see orders drop out the book as investors get a bit nervous, and then you see a pulled deal, so the deal goes to market, they don't get quite enough orders to be able to get that deal over the line in the end, then obviously that's a bad look for that issuer. So no one wants to be that issuer that does that. And touch wood, this year we haven't had many, or any, I don't think, in the euro market. So, but yeah, I think it's just that volatility. No one likes it.
I think we exceeded our time a bit here, but that was excellent conversation. And thank you, everyone. Thank you, Matt. Thank you, Bruce, for this. And thank you for listening to us. Subscribe to Credit Matters, because it absolutely does. On YouTube, Spotify, Apple, or wherever you get your podcasts, and tune in next week when we dig into more such interesting topics. And if you want to receive real-time reports, market data, you can request a free trial of IGM services, which I think they should, man. I don't know. If you haven't done it yet, what are you doing? The link is in the show notes. Thank you again and have a nice weekend. Signing off.